Welcome back to your boys, the Dividend Diplomats. This is our YouTube channel, everybody. We are going to talk to you today about a stock that has been beaten down in 2023. It is down over 12%, while that stock market is climbing this year. The question is this company that has an iconic brand? Trust me, you know this brand. You are probably even wearing this brand. There's a good chance you are. Is it an undervalued stock to buy right now? Stay tuned. We are going to tell you all about this company and let you know our thoughts on if it's an undervalued stock to buy.
Before we do, guys, make sure you smash the heck out of that subscribe button. Like this video for your boys here at the Dividend Diplomats. We have crossed over, again, the 17,000 subscriber mark, onward and upward to 18,000, and hopefully hit 20,000 by the end of this year. That's the goal. Let's get there, guys. Again, a pretty wild dividend stock here that's been, beat up pretty bad. Based on their last earnings release, down over double digits year to date, while the S&P 500 is well over double digits performance year to date. And at the same point, earnings has swung and missed for the first time in years, Bert.
Yeah.
A couple of issues going on here with this stock, but man, this is one of those beloved, iconic dividend growth stocks with a keyword on growth.
That's right. So today we're going to talk about Nike, ticker symbol NKE. We all know Nike, the Just Do It, but for all of us Cleveland people out there, there's a different reference we all know. It's the you can't see it, my arms are now. It's the "We Are All Witness" banner that
The LeBron baby.
LeBron banner. We are all witnesses right outside Quicken Loans Arena. So are we all going to be witnesses to Nike getting added to your portfolio? So we're going to find out. So that's really what it is. Nike is down over 12%, and you hit it right on the head, Lanny. This was their first earnings miss in 3 years for Nike. So since the pandemic, it was the first time the company has missed earnings. So of course the stock is going to get a little bit of a beatdown when that happens. So what were the numbers? What were the results? Net income was $1 billion compared to $1.44 billion from the previous year. Earnings per share for the quarter were 66 cents. That was below analyst estimates of 67 cents. So that's where the loss was, that first analyst loss. The
One penny.
Yeah, 1 penny. Man, they got crushed by the analysts. But it's down from 90 cents from the year earlier. Year-to-date net income is $5.1 billion, down 16%. So the bottom line is getting squeezed right now for Nike. That seems to be the story. But Lanny, what about sales? How are the sales looking for Nike? How's the top line?
Yeah, so top line obviously continues to still grow. Higher prices, is going to help Nike here. But yeah, 12.8 billion versus 12.25 billion from a year earlier. So that was kind of ahead of what they were estimating. And then, just year to date, they're looking at over 51 billion, up 10% to the previous year to date period. It's all about China right now with Nike, though, because sales are way up in China. I believe over 16% year over year after those COVID restrictions were lifted over there. But I mean, that's just top of the line right now. Obviously, that is great because, you still get the cash flow, but it seems like costs and inventory seem to be a big issue because what was the company doing during COVID, what that impact is now, and what they might have to do going forward.
Yeah, the inventory is a great point here for what's going down with Nike, because that's really a piece of it. They have built up a massive inventory. They have 8.5 billion of inventory, and that's shoes, apparel. They've got to get rid of that, even though it's down 400 million. So they're making moves to shorten it. That's still a lot just sitting there, not getting turned over, not getting turned into cash. The cash is just sitting there in their warehouses. And when I was reading up on Nike, I thought was the interesting piece. During the pandemic, they switched to direct to consumer. So that was the big channel that they were going through. They put all their chips in on online sales, direct to consumers, but that's not as hot right now. So now they're quickly trying to pull the lever back into selling through wholesalers, back through stores now to help get that inventory out there and help increase their top and bottom lines. So they're trying to move, but it's not fast to turn on some of those channels. And you might not get the same prices, the same margins in there, because once you introduce the wholesaler, that's a new cost that gets added into there. So the margin shrinks even more. That's another cost layered on top of it. their margins were squeezed. And that's why you saw the top line growth, but the bottom line shrink. Gross margin was down 1.4% to 43.6%. That's still great gross margin, but hey, margins going down, earnings are dropping. So if you have higher costs, you have higher shipping, and now you're layering in some more wholesaler costs on top of it, they're going to face some potential greater margin compression going forward if you don't get cost relief on those raw materials.
Yeah. I mean, inventory seems like a big retail problem. Obviously, now you're looking at the branded companies that thought they, again, at one point was working really well because, hey, that demand was so high. Consumers were flush with cash. Let's just go right direct. Let's just make some money that way. But yeah, I mean, 21% higher inventory right now versus 2021 levels. So now they're going to have to navigate through that, take even less margin. So bottom line shouldn't even improve based on that knowledge. Sales again will continue to grow. I think they expect, again, top line still to grow in the mid-single digits. And again, in the quarter ahead, you're probably going to still see a little bit of growth maybe on the top line, but I don't see the bottom line improving, over the next 9 to 12 months. But hey, I'm not on Wall Street. I'm not, an analyst that's tracking Nike. Nor am I in that industry, but I don't see a quick battle here. I see this being a kind of a moderate battle.
Yeah, because everything you're reading with retails, it's going to be tough because Nike isn't the only retail company signaling these issues, as you alluded to earlier. There are a lot of retail companies that are saying inventory issues, cost issues, and a lot of companies are doing the same thing, revising their estimates downward. So all those things considered, Nike has had a tough 2022. The company, interestingly, when you look at their historical stock price, this 2023, I'm sorry.
They might be down, but they're down and not out, baby.
Well, that's right, because it's Nike after all. It is Nike. They have the brand
Just do it, Nike.
Do it. Just
not,
do it. Do
yeah,
it. We
not,
know it's
not,
not
not Ben Stiller, Starsky and Hutch, not Shia LaBeouf. Just do it. But Nike, just do it.
Yes. Even so, 2050, they're down 12%. 52 weeks, they're only down 3%. Over 5 years, they're up 35%. So still, it's Nike. They're still performing well in the long run. It's just a short-term blip. When you see short-term blips like that, regardless of the company, regardless of what's going on, that's where your boys come running in to determine, is it an undervalued stock to buy? Is there a chance for us to grab Nike at some great value and add them to our portfolios? So we're going to find out. And Lanny, how are we going to find that out?
Guys, we're going to run Nike NKE through the Dividend Diplomat stock screener focused on 3 simple metrics. One, that price to earnings ratio less than the S&P 500, which is around 25 times earnings. Dividend payout ratio less than 60%, because don't you worry, Nike is well under that. Dividend growth. We want that history of growing dividends, your passive income stream, the set it and forget it method. And then we'll throw in as a bonus metric that dividend yield, and we will compare all of that to the 5-year yield on average. Nike is trading at $104.46. And man, these analysts are expecting only $3.77 on that share price. That first metric of that price to earnings ratio, man, is a little bit balmy for me at 27.71. What do you think about that?
Yeah, I agree. So it's above the S&P 500 right now, which is a pretty hard feat considering how expensive the market is. But the one thing to help up for perspective is their 5-year average PE ratio is 36 for Nike. So it's always an expensive stock. This isn't some cheap stock that's way overvalued. This is a company that trades at a premium, always trades at a premium. And right now, what you just told us with the PE being at 27, it's trading at a lesser premium than it historically does, but it's still not cheap. Woohoo. You're right there. So
how about that payout ratio?
All right. So their annual dividend, $1.36. Their payout ratio is 36%. So it's just below our perfect payout ratio range. So there's plenty of room to continue growing that dividend and maintaining it. So think about it here. If earnings per share misses again, and it doesn't miss by 1 cent, it misses by 50%. Let's say earnings drop 50%. That payout ratio will jump to 72%, and it's very well covered. So that's why we love looking at the payout ratio. The dividend is safe at the current levels as long as earnings don't have a complete 100% implosion. But no dividend would be safe if there's 100% implosion in earnings.
Yeah. But hey, let's look at that dividend growth again. Over 10 plus years of juicing up those dividends at a double-digit rate, 11.18%. And if we just dive in really quick over the Nikes, again, everybody's looking at it because, again, we'll get into that bonus metric, that, dividend yield. Their last increase, again, was kind of right on par. Went from 30.5 cents to 34 cents, so about 11.5% increase. Set 5-year average being 11.18%. They're right there, still doing it, still sticking true to it. And based on that previous metric, still can do it going forward.
Yeah, so that's the thing. They're a high dividend growth stock. And now let's look at the yield, because that's the other piece of it, is their yield is 1.3% right now. So low growth, low yield, high dividend growth stock. That is the name of Nike's game right there. Now their yield is still below the S&P 500. It's still lower than the market, but that's always what you're going to kind of get with Nike, right? You're never going to get this yield that's 2 times, 3 times the market. When you buy a stock like Nike, you know exactly what you're signing up for. It's that low yield, high dividend growth. But now we've also started adding into our analysis, how does their current yield compare to the 5-year average yield? Because that will help you assess valuation. Their current yield is much higher than their 5-year average yield. Then that's a potential sign that the stock is undervalued. So Nike's 5-year average yield is 1%. So their current yield is 1.3%. Average yield, 5-year average yield is 1%. So it's showing signs of undervaluation from a Nike perspective.
Yeah, really solid. It's a 30% premium right there when you actually think about it. So in summary, guys, PE ratio is 27.71, payouts 36%, dividend gross over 11% for 10 years, 1.3% yield over that 1% 5-year average, down 12% this year. Bert, what is your hot take, Bert? The hurt.
Nike, am I adding it? No. I mean, it doesn't fit what I want right now. But there are other people. If you want to invest in Nike, if you're saying I love Nike, I am addicted to the brand. It's something I've always wanted to own Nike stock. This isn't a bad time for you to start considering it, because from Nike's historical perspective, the stock is showing signs of undervaluation. It's not beating the market, but it's much lower than their 5-year average PE ratio. Their yield is higher than their average yield. So if you wanted to build that entry position to Nike, this isn't a bad time to do it. What price would it take for me to consider Nike? That's a different question. So I'm going to look at what would I take for Nike with a current dividend of 136 to get to certain yield thresholds. So 1.5% yield, 1.75%, 2%, where I'd really start being interested. To get a 1.5% yield, the price needs to fall to $90.66. To get to 1.75%, it'd have to fall to $77. 2%, $68. If Nike's at $68 per share, I'm assuming there are going to be plenty of other undervalued dividend stocks for me to buy, where I'd be focusing my attention instead of just Nike.
Guys, that was Bert's take. I'm not buying right now for, kind of similar reasons here. I don't really own, a brand that has, clothing products in my portfolio. I'm not really looking to start that, but I'm not saying that Nike's not a great brand, not a great, company. I mean, they've obviously been around for decades. Obviously, some big high profile athletes are with them, some of our favorites, actually. But what are you doing with Nike stock? Is this a stock to buy right now? Do you currently own Nike stock and are averaging down, or are you looking to add and create a new position by buying Nike stock right now? Let us know.
If you haven't already, subscribe to the channel, give this video a thumbs up, and if you haven't already, just remember, if you're not with us, you're against us.
That's right, guys. That was Bert, the Hurt, and Lanny from the Dividend Diplomats. Over and out.